Hello everyone and welcome to this short educational, in this case a market update video. My name is Matt Williamson with Sensa Market, and today we are going to be looking at the S&P 500. All right, it is March the 13th, 2 days before the Ides of March here, and I have an indicator pulled up on my chart here. It's not one that is in any trading platform or anything like that. It's actually a very basic indicator. But all it is we have 4 lines here. We have the all-time high, whatever that current number happens to be. We have the 5% sell-off line here, and I'm calling this a pullback. You could also call this a retracement. Okay, that's just 5% from the highs. And then this next line is 10% from the highs. And the next line here is 20% from the highs. This is the official bear market line down here. Usually people refer to this as the correction line. And again, this could be a pullback, retracement line, kind of whatever you want to call it. The reason I have those lines on the chart is because those lines are often very respected. Okay, many an institutional trader will come in at the 10% sell-off mark and do something, typically buying at that 10% level. They have clients that want to buy the dip, so they wait till we get a 10% retracement, they buy it, and it comes right back up here. Okay, same thing on these 5% retracements. We head back down 5% and institutional money comes in and buys that dip. Okay, you'll see this very frequently. We're going to go back through history here in just a moment and examine some prior moves and what it looks like when we break these levels. Okay, so let's go back just a hair. I'm just going to fly back to whatever time period this happens to be. It looks like this is 1973. I may have gone back a little too far. Let's keep it a little more relevant. This is 1983. It's still 42 years ago. It's quite a while. 1990. Let's scroll forward just a little bit. Okay. Here's the year 2000. Okay, so if we just kind of look through the lines here, here's an all-time high. Here's a pullback to 10%, and then a rip to new all-time highs. Pullback through 10%. Through 10%, back up to the 5. So that 10% line held just fine there. In this case, it took us all the way down to 20 before we started bouncing again. Okay, and then we broke the 20. Once we break that 20% off the all-time highs, it's anybody's ball game. Okay, that's the official bear market territory. You'll often see pretty nasty selling once you get to that point. So let me scroll us forward a little bit more. We'll sort of get back into more modern territory here. And this area here is the financial crisis, by the way. So just to kind of put some context here, all-time highs back in 07, all-time highs end of 07. We started selling off, seeing some cracks in the market. There's our 20% run. This is in early 2008. And then once we took out, you can see the bounce there on that 10%. Once we took out that 20%, it was just, all hands off deck at that point. So you can see it's bouncing off 20, going back up to 10, trying to bounce off 20 and then failing. So my point is these 10, 20%, 5% lines, they do hold some significance, not just for psychological reasons, but for institutional trading reasons. All right, so let me roll back over to modern day. So here's our modern day recent bull market. Okay, all-time highs, pull back to 5, all-time highs, pull back to 10. Okay, that was back in August of 24, not too long ago. Then all-time highs, pulling back to the 5 a couple times, bouncing back to all-time highs. Okay, and then here we are today. Okay, this is a scary place to be. Okay, this is a tricky place to be. If we bounce off the 10, we go back up to the 5, and then maybe we make new all-time highs. If we break the 10, we're probably heading to 20 pretty quickly. Okay, if you're a bear in this market, your next target very well could be 49.17 here on the SPX. And I'll give one final piece of information here that I think is very telling. The same levels apply to the NASDAQ. However, we've already broken the 10 in the NASDAQ. Okay, the NASDAQ should have another, 5, 6, 7% in it to get us down to that level. And the S&P hasn't done it yet. The NASDAQ should be dragging us down. So my trade at the moment is basically any bearish trade you want. I'm using put spreads, vertical put spreads, to target 49.21. It's exactly about 600 points. Not exactly 600 points, but it's pretty darn close to 600 points. And that's a big move in the S&P. It's a solid 10% move. So you can get these puts or these put spreads on the cheap and clean up. You can have easy 10-to-1 risk reward on something that I think is not 100% certainty, but I'd give it well over 50%. I would give it closer to 70 or 80% over the next couple of months. Okay, we'll leave it there for now. Just wanted to mention these lines. If you do want to add these lines to your own chart, if you're in Thinkorswim, you can just screenshot that code right there. If you're in another trading platform, all you have to do is create a line for the highest high over whatever your period is. Okay, I have the period look back to 500. Okay, that could be 1,000. It could be 200. If you set it to the all-time high over the last 20 periods or so, it's not going to work very well. Okay, and then you're just adding lines. You're taking whatever that highest high is times 0.95. That's a 5% sell-off. Taking that highest high, multiplying by 0.9. That's the 10% sell-off. And then highest high times 0.8. And that's the 20% sell-off. And this is all just setting colors and stuff. Okay, so if you want to add those lines to your chart, just add one line for the all-time high or the highest high over whatever period you're looking for, and then 3 more lines, taking that line as your reference and multiplying them times a few different spots. Okay, and again, if you're using Thinkorswim, you can just take a screenshot of this and have fun practicing your typing skills. All right, that'll do it for now. Thanks again. This is Matt Williamson for Sensa Market, and we'll catch you in the next one. Take care.